There is a clause in SpaceX's upcoming IPO filing that has never appeared in a public company prospectus at this scale before. It says Elon Musk cannot be removed as CEO without his own permission, not by the board, not by a shareholder vote, not by any mechanism the people who buy this stock will have access to. The only way to fire the CEO of SpaceX is for Elon Musk to agree to be fired. 3 of the most powerful financial officials in the United States read that clause. Before this episode is over, you will understand exactly what they found, why they responded the way they did, and what the gap between their response and current retail sentiment tells us about the story hiding behind the largest IPO in history. Welcome to The Pulse from 10-Minute Money Mindset. This week, the largest stock market offering in the history of capital markets is days away from filing its public prospectus. SpaceX is going public. The terms of that offering, who gets in, how much control they actually have, and what the most powerful pension funds in America found when they read the fine print. That is the story. Let's get into it. SpaceX is going public. The prospectus is expected this week. The listing is set for June the 12th on the Nasdaq under the ticker SPCX. The targeted capital raise is $80 billion or more, which would make it the largest initial public offering in the history of capital markets. Here is the context for that number. Saudi Aramco set the current record in December 2019 with a $29.4 billion raise. SpaceX is targeting nearly 3 times that figure at a projected valuation of $2 trillion. SpaceX generated approximately $18.5 billion in revenue in 2025, according to reporting from The Information. That combined figure includes xAI, the artificial intelligence company Musk merged into SpaceX in February of this year. A $2 trillion valuation against $18.5 billion in revenue produces a price-to-sales ratio of roughly 108. For context, Meta Platforms, which owns Facebook, Instagram, and WhatsApp, currently trades at approximately 7 times sales, and 30% of that $80 billion is being reserved for retail investors, not institutional funds, not sovereign wealth funds, individual buyers, anyone with a brokerage account. SpaceX CFO Brett Johnson told the company's syndicate of 21 underwriting banks that retail participation in this offering would be bigger than any IPO in history. The standard retail allocation for most large offerings is 5 to 10%. SpaceX is offering 3 times that. The company has also announced a 5-for-1 stock split ahead of listing, a structural move that lowers the per-share entry price and historically expands the pool of individual buyers. On June 11th, the day before the Nasdaq listing, SpaceX is hosting 1,500 retail investors at a dedicated event. Not fund managers, not institutional allocators, regular investors, invited specifically. That is not a charitable gesture. Brett Johnson told those 21 banks that SpaceX wants longer-term holders, investors who will not sell on day 2. The invitation is a strategy. Understanding that does not make the investment wrong. It makes the invitation worth reading carefully before accepting. Now we can talk about the letter. On May the 13th, New York City Comptroller Mark Levine, New York State Comptroller Thomas DiNapoli, and CalPERS CEO Marcy Frost sent a joint letter to Elon Musk. Together, they oversee more than $1 trillion in retirement savings for millions of public servants. Teachers, nurses, firefighters, police officers. Their letter called SpaceX's proposed governance structure the most management-favorable ever brought to U.S. public markets at this scale. Here is specifically what they found. SpaceX plans to issue perpetual supervoting shares. Musk retains voting control regardless of how much stock the public buys. A similar dual-class structure exists at Google and Meta. That is unusual but not unprecedented. What is unprecedented is the clause we opened with. Musk cannot be removed as CEO without his own consent. He has a contractual veto over his own termination. The board cannot act. There is no shareholder mechanism. In the history of major American public companies, no CEO at this scale has had that provision. Mark Levine said publicly that the structure dangerously undermines investor rights. There is more. SpaceX's incorporation in Texas introduces laws requiring shareholders to own at least 3% of outstanding stock to pursue derivative litigation. 3% of a $2 trillion valuation is $60 billion. The standard class action protection most retail shareholders rely on is replaced by mandatory arbitration. SpaceX did not respond publicly to the letter. Here is the number that belongs in the same sentence as the valuation but rarely appears there. According to the information, SpaceX spent $20.7 billion in 2025 to generate $18.5 billion in revenue. The company is not currently profitable. Capital expenditures exceeded revenue by more than $2 billion. That is not automatically disqualifying. Amazon lost money for years before its economics snapped into place. Tesla burned cash through most of its early history, but at a price-to-sales ratio of 108, with 30% of the offering targeted at individual investors, it is information that belongs in the conversation before June 11th. This week, an AI chipmaker called Cerebras Systems debuted on the Nasdaq. It surged 68% on day one. The following day, it shed 10% of that gain. Cerebras is worth approximately $95 billion. SpaceX is targeting a valuation of roughly 20 times that figure. When Cerebras loses 10%, that is a painful day for its investors. When a $2 trillion company loses 10% in a single session, that is $200 billion in market capitalization gone. The stakes of a first-day mispricing do not scale linearly, they compound. Prediction markets this week placed a 62% probability on SpaceX closing above $2 trillion on its first trading day. That number has climbed from 45% in early April. Retail sentiment is pricing in a record-breaking debut. The three officials who sent the letter are not. Marcy Frost runs the California Public Employees Retirement System, $573 billion under management, 2 million Californians, teachers who chose public classrooms over private sector salaries for 30 years, nurses who spent careers in hospitals when higher-paying options existed. They accepted lower wages, in exchange for a specific promise that a pension would be there. CalPERS employs entire teams whose sole purpose is to read exactly these kinds of documents before committing a single dollar. Governance analysts, forensic accountants, legal specialists whose entire expertise is IPO filings. They read the SpaceX draft. Marcy Frost co-signed the letter. That is not a procedural formality. When the person responsible for the retirement security of 2 million public employees reads a prospectus and sends a public warning to the CEO, that act carries a specific weight. The gap between that act and a 62% prediction market probability of a record-breaking valuation on day one. That gap is the entire story of this week. The prospectus will be public before June 11th. The governance terms, the revenue, the losses, the clause will all be in it. 1,500 retail investors will walk into a room the following day and hear a pitch for the largest stock offering in the history of capital markets. SpaceX may be one of the most important companies ever built. The technology is real. The revenue trajectory is real. The ambition is real. The question is whether this specific offering at this specific price with these specific governance terms deserves the same confidence that the company itself has earned. Those are different questions. This week, the most sophisticated institutional investors in the country are treating them differently. If you found this story worth your time, subscribe so you don't miss what comes next. We research it so you don't have to, and we genuinely appreciate you being here. This Friday on Mind Over Money, we cover the specific cognitive mechanism that collapses those two questions into one when the right name appears on a prospectus, the reason the governance clause feels smaller than the rockets, and why the investors most at risk in moments like this are not the ones who know the least, they are the ones who trusted what they knew to substitute for what they had not yet read.